You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block with your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome back to the Option Block. We are, of course, your bi-weekly source for all things options related. My name is Mark Longo from the OptionsInsider.com, as well as from a little thing we like to call this here Options Insider Radio Network, and I am back from my global travels, and by global I mean down to scenic and sunny Florida. It was indeed conference week in the options and derivatives realm, and I was beckoned south, but now I am back with all sorts of fun stuff to talk about here on this show and many other programs on this fine network, including VolView, so check out that one tomorrow. And if you haven't done so already, I encourage you, surf on over to the app store of your choice and check out the Options Insider Radio Network mobile app. We, of course, have it in the iOS App Store, the Google Play App Store, even the Amazon Kindle Fire App Store. So for all you Amazon junkies out there, I know there are a few of you, we even made a version for you. Check it out. You can, of course, stream all 300 plus episodes of the Option Block, download them for later listening on the train, on the plane, wherever you like to listen to the show. And you can even use the contact suite to get in touch with us. In fact, I know a few of you let us know that the Android one was missing a couple of features on the contact side. I believe all of that has been pushed through now with some updates. So you should have the same full contact suite that all the iOS folks have been enjoying. I know a lot of you guys have been using the app to reach out to us, so we love to see that. Keep it up. Check it out, the Options Insider Radio Network mobile app. I think you're going to like it. And joining me on the old all-star panel today, we have the usual cast of characters, the usual suspects, starting off with the man beaming in from scenic and lovely and mountainous St. Charles, Illinois, none other than Uncle Mike Tusaw from RCM Asset Management. Uncle Mike, welcome back to the program, sir.
Oh, thank you. Always good to be here, coming down from the mountains for a little bit of option talk every Monday and Thursday when we record it.
And I hear you and Mr. Greasy Meatball had the reins on Monday. How did that go?
Oh, went well. It's always tough to fill it to wear the shoes with which you wear, but I do my best.
I do wear those shoes with which I wear quite well.
You do.
All right, and next up, we have the man beaming in from a little bit more mountainous than St. Charles, but still not super mountainous, scenic and lovely Maine, none other than the rock lobster himself, good old Andrew Giovinazzi from OptionPit.com. Mr. G, welcome back to the show, sir.
Oh, it's always great to be here. I thought for a second they were going to get a Dr. Seuss rhyme or something. These shoes you walk, put your shoes on and go, or all the things you'll do or places you'll go, or I was just waiting for Tucson to start to break out in some sort of Dr. Seuss rap for a second. But
all the places you'll go in those shoes.
We have a 4,000 foot, like 4,500, Mount Katahdin, whatever that is. It's got some height, not the Sierra Nevadas, but you know, it's got a little bit of height.
There are a few mountains up in your way, huh? A little more than us here in scenic Illinois. And speaking of scenic Illinois, we are also joined by our last member of the All-Star panel, holding down the Options Express by Charles Schwab hot seat, none other than the Viceroy, Alex Jacobson. Alex, welcome back to the program, sir.
Good to be here, and welcome home.
Yes, it's always a dubious welcome when you come back from, 78, 85 degrees and sunny to a little bit chillier than that. Of course, it hasn't been too bad since I've been back. Certainly no polar vortex day, so that at least is nice. All right. And with the all-star panel assembled, we're going to dive right on into our first segment, the trading block.
The trading block.
All right, everybody, those shouts mean that it is time once again for the trading block, the portion of the show where we break down what was trading, what was moving the old markets, what was lighting up the old tape. And it is quite a strong day on the street today, with most of the major indices closing sharply up on the day. S&P up about a little over half a percentage point, or about 11 and a quarter handles to 1872, well north of that crucial 1800 level. The Dow up even more, up 0.7 of a percentage point to about 16,331. The Qs also up fractionally on the day, a little more than quarter of a point. And the good old VIX cash taking it on the chin, down about 2.5% to about 14.74. By the way, Andrew, I'm just going to officially announce that I'm just giving up the ghost on the not saying percents with VIX. I just came back even from the risk management conference, where there were a lot of people doing a lot of in-depth analysis of VIX in a lot of different ways, and pretty much everyone has just started referring to it as percent. So I think that jig is up, sir.
That doesn't mean they know anything. I just want to say, Wall Street has all these risk manager guys. Where were they in 2008? Huh?
They were selling swaps in AIG. Didn't you get the memo? Good money there.
Exactly. In percentage terms. You only have a 1% chance of failure here. Well, okay, let's just readjust that realized vol and see what happens.
Aside from the minutia of VIX terminology, what else lit your fire, caught your eye in today's markets?
What's catching my eye is there's an interesting it's trades. I guess the ISE is going to list options on. I don't think it'll trade the SDEX. It's kind of, I would say, like the simple man skew. You can just Google Finance SDEX. Trades in a range from like 58 to 68, but gives you a good idea of what the 30-day out skew is essentially in the SPX. So you go 30-day forward, one standard deviation out, and that gets you the at the money put to the out of the money put. And basically, you can just think of it, you're in the high 60s, you have a very steep curve, and if you're in the high 50s, you have kind of a flat curve for the index. And right now, even with at the money vol coming in a little bit, skew will not come in at all. So I think the most curious aspect that's kind of been at least tripping me up lately is watching the at the money vol come in, not having enough at the money short, or using the vol products, which really aren't moving very much because the at the money's coming in, but with the skew staying really high and kind of compensating, the vol products aren't moving at all. And I think that is a curious, effect. Normally we do have to see some compression. There hasn't been any. And methinks that basically, long equity holders are not done. They're buying puts this time and they're holding. Instead of just freaking out and selling stocks out now or bidding the juice up, they're getting a little smarter. They say, you know what? We've seen this before. We'll buy puts for protection and we'll keep some stocks and we're just going to let the market go. What that does is that makes the curve a lot steeper, makes puts more expensive, and it keeps the volatility indexes at kind of, let's just call them rosy levels. So we, post Fed announcement, I don't know if Yellen really made things less volatile. She certainly didn't drive the treasuries down a whole lot. And that's what we got. So I think we have a market here that is continuing to buy and own protection. that's still worried about the Russian thing. And I think one thing we probably didn't have on our radar at the beginning of the year was the impact of geopolitical events. And they're starting to kind of stick around and not go away, as evidenced by, the long bond rallies. I mean, when you have a Fed chairman saying, well, we might raise rates quicker than everybody thought, and the long bond still rallies, that we're out of interest rate world and we're into freak out world again. So I would have to say it's a curious volatility market, but so far, the people still like to buy stocks, and but where I'm starting to see some interest now in stocks that kind of the low multiple value stocks with the market at this level. I think like the Intels and Microsofts and stuff like that are starting to get people a little excited again. Oh, the Qs. I thought I said that earlier this week.
Interesting you mentioned the treasuries. We're going to get into that in a little bit. In our global derivatives, a guessing game, treasuries marked a surprising resurgence last year. Interesting stuff going on there. But you're right, too, about the notion of people kind of putting on their puts and then letting the dice roll and keeping on their equity positions. That seems to be the narrative we're seeing across the broad volatility and index space. People have probably already loaded up on a lot of that downside. They haven't really been chasing it as much in all the recent sell-offs as you might have expected. Part of that because they already have their protection on, and now they're kind of content to let the market do what it will. They have their stop outs. They know where they're going to get protected out on the downside, and they're looking to capture that upside, and they're not as concerned about some of the whipsaws, and that seems to kind of dovetail with some of the research we've been talking about on vol views lately. Listeners, if you haven't had a chance, check out that show. It is back, and it is in fine form, and we were talking about that on a recent episode about how in these moments when you see that quote-unquote panic, people chasing up the implied vol of that put wing on these down days, indicating that they're really panicking to get that protection on, the market in subsequent sessions does better than ever. It's kind of a counterintuitive result, but it just kind of shows that people have that protection on and they feel a little bit better, a little bit more relaxed about what can go on in the broad market, and that tends to be reflected with the indexes rallying. I think we're seeing some of that here in the marketplace right now. Uncle Mike Tusaw, what caught your eye? What took up the BBI today over there at RCM? A lot of acronyms in there, so feel free to parse it as you will.
Got it. I think in a market like this can be a lucky man's market. Not that any market isn't when you think about it, but what I've been doing lately, or what I did, I had a limit orders in to sell put spreads at just extreme levels below the market, just in case Yellen would make the market go down significantly. And the scary thing to me is that I actually almost got filled on a couple of them. I think that the way with which I like to do things in a market like this, and we can have sudden potential drops like we had yesterday, is to do things like that and kind of swing for the fences with the limit orders that we're trying to get filled on. I didn't get filled on anything, but I think that that's the way with which the BBI committee, so to speak, we've decided to take that route with us. Gold, it's actually surprising me that gold has not come down more than it has, quite honestly, with the announcement that was made yesterday. Not that it was any big surprise, but I'm really kind of not concerned, but I'm surprised that we didn't have more of a pullback in that. And then with the market doing what it did, it goes way down, but hey, buyers came in. What the heck? It's euphoria. Markets always go up, right?
I like that notion of the BBI committee. That's just everyone sitting around and pondering the BBI for hours at end.
That's what we do here.
Should Tusaw go to the bathroom now? Yes, I think he should go right now. Send him right now.
I need to get permission.
I like that. That's a good and also disturbing image at the same time, which is a good thing, I think, overall. All right. And Mr. Alex, what was cooking in the land of OX? Give us a little bit of a preview of the Xpress Block, sir.
What was cooking? Well, the German 10-year is still trading a 50 realized vol, and as Andrew pointed out, our 10-year is doing nothing. So that's kind of the dichotomy of one side of it is Yellen yesterday, and the other side of it is Putin in the German 10-year. But in terms of the Xpress Block, we're going to talk about a couple things today. one of which is OX Tools migrating over to the Schwab platform, both in their conventional platform and their chains. So big enhancements on the Schwab side. And, we'll talk a little bit about that when we get into the Xpress Block.
I know our listeners love the tools. They love the hardcore stuff you guys keep putting down the pike for them to play with. So I think they'll be pretty excited about that. A few other things I want to hit on here in the old trading block. I don't like to give a lot of attention to the tinfoil hat crowd, but I will say when all the Crimea stuff started breaking a few weeks back, I got a lot more calls and emails than usual saying, the reason Putin's doing this is because he's long nat gas or whatever the case may be. I usually tend to dismiss a lot of that nonsense. We did see today, though, that they added some more names to the list of frozen assets, including this Swiss-based oil trader Gunvor Group. And the reason they added them today is because Putin is an investor in that company and may have access to their funds. So who knows? Maybe there was some truth to that rumor that he was long nat gas or long oil, kind of the reverse of the bin Laden puts everyone talked about back after 9/11. These are the Putin calls, apparently. And who knows? Maybe there was some rumor, some merit to those rumors after all, given what we saw today. But the real thing I want to get to here in the old trading block, we've talked in the past and on the Xpress Block, play that little Schwab OX guessing game. It's been pretty fun. We're going to expand upon that today. So all you guys need to put on your thinking caps, because I just came back, like I said, from the Futures Industry Association conference. I mentioned some of the numbers on the last episode about global derivatives and how well they've been doing futures and options worldwide and how well they did in 2013. We're going to drill down into that a little bit right now. We're going to guess collectively the top products across the product categories here globally from a derivatives perspective here in 2013. Remember, this is contract volume. This isn't notional size. This isn't multiplier. This is just pure up contract, which product did the most contracts in a particular product category. So everybody put your guessing game hats on, because we're going to kick it off. Let's see, where should we start? Let's start close to home. Let's start in the equity index land. So let's see, maybe Mr. Andrew, we'll give you pride of place. We'll let you guess first. What product do you think globally in 2013, which index product, could be a future, could be an option, did the most contract volume in 2013?
VIX.
That's your guess? Futures or options?
Options.
That would be number 11.
Whoa!
So you're way off. Remember, this isn't notional value. This is pure contracts. So keep that in mind when you're thinking. Mr. Tusaw, you're up next. What's your guess, sir?
If it's pure, you said it's pure contract number?
Yep. Just so it could be SPY versus SPX. It won't matter. They just want to look at the pure raw numbers.
I'm tempted to say the E-micros since it's contract value, but I'll go with SPY. SPY.
Options. Okay, yeah, that's the only derivative they have on there, obviously. So only the options. Yes, you're number 9. Excuse me. Actually, no, I'm sorry. I take that back. You are close to the top. I was looking at something else. You are actually number 2. SPY options. 596 million contracts, up about 2% last year. So, Alex, you get to take your tilt at the number 1 spot. What's your guess, sir?
KOSPI or Eurostocks, and I'm going to go with Eurostocks.
Interesting choice, going a little bit farther afield. It's kind of what you have to do in some of these names. Not far enough afield, sir. Let me just say, the number 1 equity index equity index derivative for all of 2013 was the CNX Nifty options, doing a whopping 875 million contracts last year, up about 9%. So there you go, Andrew and Mike. I can't believe you didn't jump immediately with it. There you go. See, that's why this list is so fun.
Is it a Chinese, Euro, Shanghai? What is it? CNX?
That is, I believe that's India. Is that not?
I think it is India, and I think you have to be an Indian resident to trade those. Don't you?
There are some unique rules on that. I'll have to pull up the list and see what the exact.
Well, there are a lot of Indian residents.
That's true. They each did a 1 lot. You're good.
Yeah, all done for the year. We're done.
Tucson, we'll get more into your neck of the woods next with the metals. So I'm just gonna give you a hint here. This one is maybe not what you think it might be, the leader, and we'll just go with that. So Mr. Tucson, as the precious metals, I should say, devotee here among us, what is your pick for the number 1 overall global metals contract in 2013. Could be a future, could be an option, could be shiny, could be industrial, whatever the case may be.
Oh, it can be industrial as well?
Any metal.
I will go with palladium, just because you wouldn't be doing this if it was gold.
Palladium. I don't even have that anywhere on my list, sir. So unfortunately, you get the buzzer. You get a whammy on that one.
All right.
Alex, you're up next, sir. What's your pick for the number one metals contract of 2013?
I'm going to do the layup and say it's gold.
Would that be the ETF, GLD options, COMEX gold futures, COMEX gold options? What's your pleasure, sir?
COMEX gold options.
Well, the gold options aren't at the top of the list. The COMEX gold futures are number 6, and they did 47 million contracts, up 7.7%. So not a huge from a contract volume perspective, but again, that's a pretty meaty contract. So there's some size behind those numbers. Just staying in the gold realm. Well, actually, I'll give Andrew his choice, and then I'll list off the rest.
Wait,
so Andrew,
you're saying it's in the gold realm?
I'm not saying it's in the gold. I was going to stay with the gold realm.
I was thinking maybe copper.
Copper, an interesting choice as well. Also not on the, actually it might be in the overall list. If I look really quickly, I can find out where copper was, but it is not in the top, blah, 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 1 second. Okay. Yes, copper, actually the copper futures on the Shanghai Futures Exchange were number 3 with 65 million contracts, about 12.2% up last year. And then of course the copper on the COMEX, number 6 with, oh wait, no, I said COMEX gold was, number 6 is COMEX gold, so copper is blah blah blah. Where did I see that? Copper on the London on the LME it was number 7. So copper combined, but we're not doing net metals. We're doing just pure contracts. So if you do net metals, still not copper. But you're close. But yes, the number 1 metals contract by volume last year was my favorite, the steel rebar futures. On the Shanghai Futures Exchange, they did 294 million contracts, up 63% from 2012. So there you go.
A million contracts a day.
Yes. That's serious business.
That's a million contracts a day.
Yes.
On rebar futures.
Yes. I know. I check it every morning with my coffee. Don't you guys?
I at some point I heard like the mung bean future is, because there's a lot of speculative juices running over there in China, like one of the highest traded futures around. So I'm curious if we get to the commodities that will be there.
Yes. Let's just finish off the metals here really quickly. Number 2 in the metals, also coming out of Shanghai, the silver futures on the Shanghai Futures Exchange, doing 173 million contracts last year. So just Shanghai just knocking it out of the park from a metals perspective. GLD, Uncle Mike's favorite, the GLD options, 49 million contracts, down 10.2% last year. So for all the love we give GLD on this show, all the interest it gets in the broad media, not exactly a huge mover from a contract perspective. And again, that's on a 1/10 size contract. So not the biggest notional or volume winner on the list. COMEX gold, number 6, 47 million contracts. And then your other favorite, Uncle Mike, SLV options coming in at number 10, 30 million contracts, down 17.4% in 2013. So not a bang up year for the precious shiny stuff.
Interesting.
All right, you want to get deep into the commodity realm, Andrew? We can do that. Let's go to the ags. This is the good one. Who wants to? Since you brought it up, you get to go first.
I'm going mung bean future.
I don't even have that on my list, sir. So I'll give you.
That'd be like a soybean future somewhere in Shanghai.
Ah, good guess. The number 1 ag contract in 2013 was the soy meals future.
That's it. Yep.
On the Dalian Commodities Exchange, doing 265 million contracts.
Yep.
And again, just knocking out of the park. Down 18.6% last year, and still leading the list. Again, probably a smaller multiplier contract, but still interesting. Some of the contracts that you and I talk about and know and love here in the States, like the corn futures, they came in at number 7, 64 million contracts, down 12%. The options on corn were at number 12 on the list. They list them separately, obviously. That did 23.5 million contracts, down about 11.5%. You add those two together, corn did about 88 million derivative contracts last year. Again, that's a pretty large contract, so notionally probably represents probably more than these soy meal futures. I don't know the exact multiplier on the soy meal futures, but still, from a net contract perspective, corn not leading the charge. Soybeans, number 8. The futures doing 46.7 million contracts last year. Let's move over to energies. Uncle Mike, you like playing in the energies, so we'll do that with you one as well. What's your pick for the number one energy contract of 2013, sir?
Nat gas. Options.
If that was this year, I might agree with you. Last year was actually a rough year for nat gas. Nat gas futures on MCX and NYMEX were down 15% and 13% respectively. So I think that narrative is going to change a little bit this year if everything else holds course. But last year, not exactly a strong year for nat gas. Mr. Alex, what's your guess in the energy realm, sir?
The CL options, the crude options contract.
Is that the ICE or the WTI? Which one are you talking about?
That's the NYMEX.
Oh, the NYMEX crude. Yeah, so the light sweet crude on the NYMEX, the futures, came in at number 2, doing 148 million barrels, up about 5% last year. And then some other... Actually, you were a little closer than you might have thought, Uncle Mike, with the some of the nat gas futures came in a little bit better at... let's see, they did 84 million contracts last year. They were down 11%, but they still managed to make number 3. So you weren't as far off. Some of the other stuff were actually taking worse beatings than the Henry Hub nat gas that everyone loves to trade so much. All right, and then so the number one contract, though, by volume was indeed the ICE Brent crude, doing 159 million contracts, up about 7.9, about 8% last year. And I guess
that was going to be my guess, by the way.
Oh, it was. Did I not give you a guess?
No, you hosed me.
Well, there you go then. The world will never know if you are telling the truth or if you are just gaming the system. So there you go.
Exactly. They will never know. Much like what Putin's got in mind, we will never know until he does it.
I'll give you a layup then to take us home, Mr. Andrew. What's your guess for the number one rates product in 2013?
Ooh, the Eurodollar options.
Yes, he is a winner. So at least on this one, we know he's not guessing or not gaming the system, I should say. Eurodollar, lighting up the tape, doing 517 million contracts last year, up 21.3%. The mid-curve options also coming in on the list, doing 122 million contracts, up 34%. So yeah, the rates complex in general is kind of the narrative of last year. It came back to life after just taking it on the chin the previous couple of years. Number 3 on the list is the 10-year notes futures, also doing 326 million contracts, up 23% last year as well. So the rates complex across the board just kind of catching fire last year after a few weak years. All right, we'll actually finish it up with this one last one. We'll go to FX and we'll finish it up with that. Uncle Mike, I'll let you have a last shot here at FX. What is your number one FX contract in 2013 guess, sir?
I'll go with the yen.
I will give you another whammy, sir. That's 2 whammies for you.
Oh, my goodness.
Alex, what's your guess, sir?
I would have gone with the yen euro. So if it's not the yen, I'd have to go with the euro.
Uh-oh. Alex gets a whammy as well. The whammies are lighting up the tape here. Press your luck, Mr. Andrew. What is your guess?
Darn. Yen. Straight up yen.
You get a whammy just for repeating Tusa.
Is that what he said?
Yeah, he said yen.
Hold it. Tusa said yen. Alex said euro. Dang.
I'll give you
British
a hint. Go a little bit farther afield. It is not the British pound either, sir. The number one.
There isn't a renminbi. There isn't a Chinese a contract there.
No, not China.
Yuan, right?
Not China. The other big player out there. It was the U.S. dollar Indian rupee futures contract on the National Stock Exchange over there in India, doing a whopping 566 million contracts, even though it was down nearly 9% in volume. So there you go. The dollar rupee lighting up the tape last year. I think that's a smaller size contract as well, hence the massive size of that. So there you go. When you wake up in the morning now and have your coffee, you check, your S&P and your Apple. You also have to check your steel, rebar futures, and your dollar rupee, and you're good to go.
Yeah, the Indian market's been moving. They got that new prime minister guy, and that was one of the best calls I saw. Like they love that guy. So the guy said, "Oh, this market's going to rally until the election," and he was right.
All right, good
sidelight comment, worthless comment.
All right, good stuff here for the old guessing game. Once a year, we get to go global, and it's kind of fun. But now it's time to keep on rolling right on into our next segment, the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, that funky tune means it's time once again for the old Odd Block. This is the portion of the show where we break down the weird trades that are lighting up the old tape here from an options perspective. Going to kick things off with ANR. I believe this is the newcomer to the Odd Block. Alpha Natural Resources Inc. Closing today, $4.24, down about 5% on the day. This is the name that does about 17,000 contracts a day, doing a whopping 50,000 today. So they're lighting up the old tape, and all of that volume was in the call side. 8.5 to 1 call to put ratio out here in ANR. So that should give you some idea of what was going on out here. It was a pretty size call spread that took up most of the oxygen in the room out here in ANR. In order to get all the details, we got to roll on out here to Jan. And we got to roll on out to the Jan 5 and 7 strikes, respectively, because we saw 20,000 of the Jan 5-7 spreads going up. It went up in 4 blocks just inside the bid offer. So we saw someone obviously putting this up between the markets. And it looks like anyway, this is opening, even though there is some size paper open on the 7s, a 51,000 and 14,000 on the 5. So this to your mind isn't a roll down here, Andrew, right? I think this is all open in paper?
I think it's all opening. Well, the thing is, what's opening for sure is the 5s. So they're going to dump their 7s and then buy the 5s. I mean, I guess I could buy that as a trade, possible. I just think somebody's buying the 5-7 spread for not very much money, for what, 25 cents or something like that. It's pretty cheap. So I'm looking at these coal stocks myself as a, because probably they're at zero. The hard thing is they're going to recover. Which ones are going to go out of business and which ones are going to stick around? So this used to be kind of a favorite stock of, wasn't this a Kramer stock, ANR, a while ago? Anyway,
it sounds familiar.
Yeah, they've been having used to make lots of money. Now it don't make so much money. So it was $119 in 2007, and now it is $4.
Yeah, just whenever I see 50K line on a strike like that and not much around it, it always piques my interest that it's probably a roll down, but it could be opening. You never know. We'll find out tomorrow. Listeners playing the home game when you listen to the show tomorrow, let us know if we're right or if Andrew's just completely crazy, which he might be.
Either way, they want to get longer.
Yes.
As far as I can see. So they want to get that, ANR's making close to, year lows. It's making year lows, multi-year lows. It's making a low every way you can make a low.
Yeah, so, this is the quality name.
Yeah, the whole industry is like that.
That's us in the Odd Block. Nothing but quality.
That's how we try.
Speaking of quality, if $4 was too rich for your blood, then you're going to love this next one. This is Mast Therapeutics Inc., ticker symbol MSTX, closing today a whopping 83 cents. This is the name that does, about 1,300 contracts a day, doing nearly 19,000 today. The bulk of that coming in, I love these ones on the 1 strike. I have a hard time saying 1 with a straight face. But we saw the July 1s going up for size today. When we wrote it up this morning, it was blocks of 5,000, a total of 12,000 on the day. Looks like this was a size overwrite here. Is that your take as well, Andrew? Even though there's 28,000 open on this strike as well. So
what's crazy is was a 15-cent buyer early. And I still think they're buying. So I don't know if they're closing their 1 strike or they're getting a new long, but whoever is short the ones are covering. So maybe they've got something in the offing here coming up, but you're covering your ones, you're covering your one calls. I'm going to assume you long the stock, I guess. So I think overall it looks bullish, but there's no shortage of people coming in to sell the there was no shortage of people coming in to sell the 15-cent bid earlier, and all of a sudden that went away. Now it's offered 20. So, a stock that looks like it's probably worthless, but somebody cares a lot to cover these calls, and they're spending some money. I mean, if you have the buy right on, why bother? But somebody wants them.
This is like the second time in a few weeks we talked about closing on the ones. It just sounds wrong on several levels.
It's a little mind-boggling.
Yeah, we're getting some crazy paper up here.
Love your broker.
All right, next up, speaking of brokers, or at least banks, next up we have RBS. This is the Royal Bank of Scotland. A little bit more regular in the price territory, trading $10.14 today, up about 1.5%. This is the name doing about 650 contracts a day, doing about 2,300 today, and pretty much almost all of that 2,300 coming in one size print on the AUG 10 strikes, AUG 10 calls, going up 2,312 times today. Looks like the bulk of it came in a big block in the morning. A buyer came in and just gobbled up the offer on these things looks like for about $1. And just gobbling up some, I can't even call it upside, at the monies. Don't see that too often. That in and of itself is kind of interesting. Only 1,600 on the strike, so it can't be closing. Someone gobbling up some at the monies here in RBS. Senior Andrew, what's your take on this one?
Just straight out get long. If there's getting long banks, I think that might be the closet type of pick for 2014. If we get a little movement in interest rates, maybe banks make a little more money. There's not all this, or maybe the government will start leaving the banks alone so they can try making money again. Either way, this is like good old-fashioned bull market. I want to buy some at-the-money calls. Don't see it too much anymore, but there you go. That's the bullish paper as you can get, I would say.
Speaking of bullish paper, we're going to wrap things up in the odd block here with a trip over to Japan. The iShares MSCI Japan ETF, ticker symbol EWJ, closing today $10.93, roughly unched on the day. And we saw this gets the winner for the size paper of the day, at least from an odd block perspective. Saw someone coming in just blasting out a ton of these March 11 puts to the tune of 85,000 of these things by the end of the day, blasting them out for a dime. Of course, the open interest is 180,000, so that's any indication he probably has 100,000 more to go. Could be a long equity holder saying now's the time to hit that bid while the time is right. Certainly looks, not a long equity holder. Could be a long option holder. Looks like he's trying to close out what he's got. Got a ton here on this strike. Senior Andrew, is that your take as well? This 180,000 is looking to catch that bid and run with it?
Yep. I mean, he probably thought they were worthless until Japan, had a meltdown the last couple days. So he's taken his dime a bajillion times.
Yeah, take your dime and go home.
What's interesting is, the liquidity providers are buying those, and obviously buying tons of the EWJ underlying. And, I guess they got what, 1 day. Got 1 day for a 3 or 2 cent synthetic call. Probably go out worthless, but they got a lot of it. So we'll see what happens if there's any good overnight news.
They're paying about 3 cents for that privilege. Not the biggest flyer, but of course you do anything a couple 100,000 times, it could leave a mark. All right, and that is going to do it for the odd block today. Certainly some odd stuff in there of all different sizes and shapes and colors. Let us know what you think when you look at the open interest and what your take is on these trades. Meanwhile, we're going to keep on rolling right on into Alex's favorite part of the show, the Express Block.
The Express Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, Mr. Alex, you teased it at the top of the show, but a lot of cool new tools coming down the Schwab way, not just the OX way. So tell us what's coming down the pike from a tools perspective over there at Options Express by Charles Schwab.
Yeah, part of the obviously intent of Schwab buying OX was to migrate and integrate some of the great tools that OX has. And I don't want to say it's stage one, but the integration process has resulted in a number of enhancements to the Schwab platform that were released in the last couple days. And this is kind of just the beginning, but the first enhancement now is when you hit your positions page, options and their underlyings were always shown separately. Now the option is shown right below the underlying. So you got 500 shares of IBM and you've got 5 short calls against it. Those short calls are now in the line right below IBM. So that's great if you have a position tied to an equity, a covered call, mirrored put, a 1x2 if you're doing some kind of remedy strategy. But that's enhancement number one. There are a lot of enhancements. I'm just going to touch on a couple of them. The other thing is the smart chains. The OX chains have now migrated to the Schwab platform. So you're going to see a smarter option chain. And here's the third thing. You can now trade from the chains on the Schwab platform. And in fact, again, this first stage is you can trade 2-leg spreads from the chains. Obviously, one of the intents when Schwab bought OX was to bring the all-in-one trade ticket in the 4-leg chain, and that's up the road. But right now you can do 2-legged chains, 2-leg trades direct from the chains. And speaking of 2 legs, I've talked about the fact that Idea Hub has migrated to the Schwab mobile platform. That is being released literally as we speak. And that will have 2-legged ideas in the Idea Hub. On the OX platform, we have 4-legged ideas in the Idea Hub. So we have the Iron Condor. The Schwab mobile release will have the credit put spread and the credit call spread. But the intent is eventually to get that to the 4-legged trade ticket. So that's coming. And of course, whenever I say it's coming, I immediately get 400 emails wanting to know what time Friday that will be released. That's not going to be released Friday. Right now, we're at 2 legs. The other thing I wanted to point out was the former host of the show, John Grigas, was promoted this week to MD, Managing Director of Client Services. So kudos to John. I know we didn't have him. He doesn't come on the show that much anymore now that he's a senior executive and occasionally wearing a tie. I know we had him on for the anniversary show, but kudos to John. John essentially at OX runs the trading desk and the service desk, and kudos to him for making MD.
Yes, that is good news. And see, like I've said many times, good things happen to you when you start your day here on the option block and start your career in many ways. So yes, good things are shine rubbed off on him. I'm glad to see that. We can take all credit for his success, of course. And good things to hear about these platforms too, because that was one of the things that intrigued me the most when the acquisition was announced with Schwab and OX, is them being able to port some of the awesome tools you guys have over at OX over there to the more, let's say, general audience over there at Schwab. And so giving them some of the robustness of that platform, giving them the multiple legs, the things that you're talking about here, that can only really help, I think, and go a long way towards educating that audience on options and getting them a little bit more comfortable with using the product. And that's a good thing for them and for everybody, I think. So I'm very glad to hear that these developments are in the pike and coming soon. Thank you for that, Mr. Viceroy. Now we're going to keep on rolling right on into my favorite segment. Don't tell these guys, but it's your segment. It's the mail block.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, everybody, I'm going to keep hustling through this because I want to make sure we get at least a few of you guys in here on the mail block. A lot of people writing in. I love you guys who send in multiple questions, too. Just be aware we can only feature one at a time, even though I would love to feature 5 or 6 questions from each of you. We got to surface one, so we'll try to pick the best. First one comes from the website, from a user who goes by the handle Theta Thumper. I like that one. I may have to borrow that myself. He writes, here's a question for one of your shows. Options Insider, maybe? Well, we're going to put it on Option Block. Options Insider is more of an interview show. He writes, you often talk about hedging a portfolio. If you decide to do it the simple way and hedge by buying a long-dated put on the SPY, put in quotation marks there, which is kind of funny, and he puts in parentheses instead of using the VIX, is it better to buy a put at, say, 15 to 20% below the market for the full amount of your portfolio, or use the same amount of cash you would have used for that to hedge closer to the money, but with a smaller percentage of the portfolio? My concept is to use 1% of my portfolio per year as a hedge. Thanks, Theta Thumper. Well, Theta Thumper, great question. This is kind of the $1 million question right now. Everyone's asking some variation on this because a lot of you are sitting in gains in your broad equity portfolios and you're wondering, hey, what do I do now to lock these in? And you all come back to the same question. Roughly, how much should I be paying for this type of protection? First off, I want to say I'm glad you're using SPY puts and not VIX. We've covered that many times on the show. VIX is not really a hedge, so don't think of it in that case. You want to think of it as a kicker, that's fine. As a direct hedge, you're playing with fire. So I'm glad you're using SPY puts instead. I will say before, I know Tusaw's champing at the bits, I'll let him go in a second, but I will say that in general, your concept of 1% of your portfolio a year to work as a hedge is a little conservative. I think you're going to really have to pay up a little bit more to get the true type of protection that you want. Now, it depends. You put a scenario there. It depends if you want to just be break even and protect at the break even point, in which case you probably can get away with that, or if you actually want to protect those gains. And I'm guessing you want to do the latter, in which case you're going to have to pay up a little bit more and work on some of the interesting strategies we talked about here on this show in the past in order to offset some of the premium, whether it's a collar, whether it's a put spread on that gains portion of your portfolio, allow to offset some of that premium. There's a lot of interesting ways that we could structure that. Before I go any further, I know Mike's really excited to talk about this one. So, Mike, I'll let you go. Then I will dive in at the end. So, Uncle Mike, what do you have to say here for our friend, Mr. Theta Thumper?
Well, a couple things. I want to reiterate my inner joy that you are using SPY and not the VIX. We've gone through that many times, as you said, and I like to refer to that. If you're doing it for your big money, your portfolio, it's like buying car insurance on your house. For trading, obviously different story, but for serious hedging, I don't think that makes a lot of sense. Now, with this, what I'd like to emphasize and how we do it is that we like to take probably about 10% of the portfolio and use it towards hedging. Now, usually we're not using it all. Like right now, for example, we have an SPY position with which we're using probably maybe 3 to 4% right now at absolute most, but we still have the other 6 to 7% sitting in cash, ready to buy more puts or whatever we need to do with it. I prefer more along the lines of hedging all of it with something more out of the money. I think that makes more sense just because of the fact that you have all your money. Why not hedge all of it? With that being said, though, we like to sectionalize the portfolio in that this is your hedged stock section. This is your unhedged stock section. So with that in mind, let's say that we had $100,000 and we wanted to put 50% in bonds, 50% in stocks. I'll just oversimplify this. And in stocks, we want to have 25% or 25 grand hedged, 25 grand unhedged. So what we would have is 50 grand in bonds, 25 grand in, we'll just say SPY to keep things simple, and then another 25 grand that we would use to have a hedged portfolio to where probably about maybe 20 to 22 grand is actually in the stocks, but the remaining amount of that section of that money is actually being hedged or is being used to hedge the entire hedged section of the portfolio. And that's how we do it.
Go ahead, Andrew. I know you're champing at the bit here.
The only thing I wanted to say is don't forget, when the market, falls apart, where's the volatility going to be? So if you own some of these little SPY puts grow into big SPY puts when the volatility goes from, let's say, 14% to 28%. So there is a Vega kicker that makes those puts kind of blossom into something really, really fantastic. And at that point, you should have some type of BBI-esque strategy like Mike has to do something with the puts that have blown up in value, right? Because those puts will offset your equity losers. But if the market goes up, right, did you accomplish anything with the puts? You made yourself feel better, but you really didn't make, you didn't do any better than somebody else that just sat there and did nothing, right? Because if you both own stock and the market drops, right, you both lose money. If you own puts, you're like, wow, my puts made me money. And if you all both do nothing and the market goes right back up again, right, you both are in the exact same spot and you're out the money you spent on your puts. So you need some sort of regime to deal with the puts you have. Are you going to buy more equities because you have less long exposure? Are you going to sell your puts and maybe roll the term a little cheaper, keep your protection, and basically harvest the huge Vega dollars that you just made, but still but actually increase the gamma? So you should think a little bit about what you want to do with your puts, because if you do nothing and the market bounces right back again, right, you've net gained really nothing by having the hedge.
Have a plan for your puts. I like it. Mr. Alex, Mr. Viceroy, anything here for our friend Theta Thumper?
Yeah, I'm going to do one quick comment, which is this is a philosophy question, and you got to look at your choices. And as I listened to Mike describe one of the scenarios, I think what we demonstrate here and what Mr. Theta Thumper, that's obviously a tongue twister, should think about is the terrific value of having somebody like a Mike manage your portfolio. Because as I listened to Mike talk about, how he would build the portfolio, you realize the value of a terrific RIA. We can talk insurance forever. How far out of the money, how long, how short, but having some oversight or thinking about oversight is really of high value.
That's a good point, and I would just go back to that point again about your 1%. That really is very conservative. I don't think you're really going to get much bang for your buck at all using 1%. We'll debate this on many of our shows on the network, our advisor show. People write into that one all the time with a similar type of question. What rule of thumb is there for how much I should pay for my protection, for my portfolio? All these different variations on this type of question. And moral of the story, they're all pretty much above 1%. You're talking maybe in the 3 to 6 month time frame, you're talking closer to that, the money, you probably should be looking at least 1.5%, maybe even 2%. That's outright. There are strategies you could use to reduce that premium. In fact, Uncle Mike talks about them almost on an episode by episode basis here on that show. So if you want to reduce that outlay, you need to do some stuff, like Andrew likes to say, and that kind of gets into what Tusa has been talking about a lot lately with doing the strips, doing the short-term calendars. You got the longer-term put, writing the nearer-term puts against it. If you really want to reduce the amount you're paying and get the full bang for your protection, you're going to have to do a lot of stuff, and that really gets down to being pretty sophisticated from an options perspective. So if you're not comfortable doing all that stuff, doing these near-term calendars, paying for long-term puts, constructing zero-cost collars, and then rolling them again and again and again, things like that. If you're not comfortable doing that, then it probably is worth paying up a little bit to have someone construct that stuff for you. But at the end of the day, if you want protection, it's going to cost you probably more than 1%. Just aim for that, and you'll be safe. Unfortunately, that is all the time we have for the mail block today. I want to encourage all you guys to keep writing in, and I was just teasing. You can send in multiple questions. That's fine. We'll pick our favorites, and then if we don't get to them, we'll get to them the following. Maybe we'll have an extra mail block next week because so many of you guys are writing in with so many great questions. But we're going to keep on rolling right on into our final segment, Around the Block.
Around the block.
All right, and welcome to Around the Block. This is, of course, the portion of the show where we tell you what we're keeping an eye on for the rest of this week into the weekend. Of course, Mr. Putin, the Crimea really being top of mind for most people. A lot of people really kind of, that's the big unknown out there in the ether. But aside from that, Mr. Andrew, what else are you paying attention to, sir?
Again, waiting for the skew to sort of, let's just call it, come in. If it does that, waiting for bonds to move. Maybe we're just stuck again for the next year. I just find a lot of this, a lot of it very surprising and interesting, essentially. The fact that it really isn't, that part of the market, I think there's still a lot of worry about the geopolitical stuff when most of the economic news is good. I mean, we seem to be getting through the Obamacare rollout and all that other kind of stuff. So, the fact that the Fed does not need to buy bonds, everybody should take that as positive, as in the economy is getting better. When the economy gets better, companies make more money. Long term, that's good. We did okay in the 90s without the Fed intervening at all. So I'd like to get back to those days.
Oh, you diehard libertarian, you.
I know. What are you going to do?
All right, Mr. Alex, what are you watching for the rest of this week into the weekend, sir?
Obviously watching Putin and the events there, but I'll tell you what else I think has been very telling lately, and that's been the daily move in the U.S. 10-year, the daily move in the Bund, and the daily move in the Japanese 10-year. It was very curious today when the vol came out of our 10-year, but stayed in the German and the Japanese, and we rallied. And I think that's a lot of what Andrew was talking about here, that what you're seeing is sort of a window into Fed policy. And I think it's a much cleaner picture to look at the daily moves in the 10 years to give you a sense of how confident the markets are, and the clocks are singing in the background.
Actually, we can't really hear it that well, so that's good for this one. All right, and last, and only sometimes least, Uncle Mike Tusaw, what are you watching for the rest of this week into the weekend?
Well, just to kind of reiterate what Alex and Andrew had said, obviously the global events and seeing how the market continues to digest what the Fed had to say. And I'd love to go back to the 90s. That would be kind of fun. But the other thing, I'm just to kind of talk about what I talked about at the beginning of the show. I'm liking gold right now, just from the short term. And I think this might be a chance for us to increase some deltas on it. Don't know yet. Make up our minds tomorrow, but I'm liking what I'm seeing.
The gold bug is out in force again. You heard it here first, listeners. Uncle Mike never saw something shiny he didn't like.
There we go.
All right. And that is going to do it for the Around the Block segment. It's also going to do it for this episode of the Option Block. But before we check out for this week, let me check in with each of my cohorts and partners in crime to see what they have cooking that may interest you until the next time we gather here together on the All-Star panel. Starting off with you, Mr. Andrew, what's cooking in the land? Oh, the pit.
We are releasing our all online gold course. It's not all online, but the instructional part is. So if you are saying, hey, I want to learn about all the stuff you guys talked about on the show, you could actually take part of the course on your iPhone. We have it all streaming. There are 2 live sessions though per week with either me or Mark, get you into what will be our chat service that we're going to launch that starts in April. So it's a great way to learn all the little, and all of the recorded content is only about 5 to 6 minutes per vignette. So you get kind of a little, if you want to learn about very specific parts on options, it's all recorded with extra materials, slide decks and stuff like that. So it's pretty cool. and it's in a convenient, easy to digest format for people that want to learn about options. And if you say you heard it on the Option Insider Radio Network, we'll give you a couple $100 off on the launch of the Gold course. So those things will start Monday. Anybody that's interested, even if you call us Friday, I will find a way to squeeze you in. But we'll be basically signing up the courses, basically every month, essentially.
I like it. Maybe throwing a free lobster dinner over there in Maine with you and the family. It sounds like a good deal. I like it.
Potentially, that could be. We'd throw in a lobster dinner if in Maine if we had a purchaser.
There you go.
I can do that.
There you go, listeners. You heard it here first.
But I'm not flying you to Maine if you live in Japan or something.
That's the caveat. If you live in Texas, got to make your way to Maine.
Okay, you're out. You got to get here.
All right. And Mr. Alex, what's coming up in the land of OX education?
So 3 events I'll talk about, and one on a topic we don't talk about much. Forex is now integrated into the OX platform. So on Tuesday, the 25th of March, Jeremy Wagner from Daily FX is going to talk Forex. Forex has been integrated in the platform for 5 or 6 months now, and I know we don't talk a lot about it, but we're bringing up a whole calendar of Forex educational events. Wednesday, March 26th, Nita's going to do a platform tour talking about a lot of the new features. A line of events, Saturday the 29th, Jimmy Rouzan will be in Baton Rouge, Louisiana, doing his quarter of a day event. He's got big numbers for it already. A couple of the universities down there have supported it, which is terrific because it's always good to see, college folks coming out for these events. But it's Saturday, March 29th. And if you don't want to fly to Baton Rouge or you're not in the Baton Rouge neighborhood, simulcast on the site. All the events are free. Just go to optionsexpress.com and click on the education tab.
I like it. More FX stuff. Now I can finally get all my info on my dollar Indian rupee futures that are lighting up the tape over there on the NSE. All right, and last but certainly not least, Senior Uncle Mike, what is coming up in the RCM webinar train?
Last night, since this will be broadcast on Friday, we had a great webinar on sideways market trading. And then we're not going to have anything the coming week, but we have a full slate of events set up for the month of April, and we will have more information on that as we draw closer.
I am withdrawing my sign up until I get my much delayed Stupids webinar, sir.
One of these days, I'm going to do that for you.
Yeah, I'll have to tell you. We'll have to talk about it on a later episode. I did see some cool software down at one of the conferences this week that actually recommended some Stupids. I'd never seen that before. So that was interesting in and of itself. But stay tuned. Perhaps we'll talk about that on a coming show, listeners. But that's all the time we have for this episode of the Option Block. I want to, of course, thank Andrew and Uncle Mike and the Viceroy, and, of course, all of you guys out there in the listening audience for downloading and streaming and subscribing to this program, for sending in such great questions. Keep them up. I promise we'll squeeze in more next time. And we'll see you next time right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.